5 steps to wealth accumulation. Now, I happen to have a lot of experience in trying and failing various methods of wealth accumulation. There are some people that have to learn by experience, and they experiment, fail, to finally find something that works for them. And I'm one of those people. So as much as I like to learn about wealth and read about it and listen to people talk about it, I have to go out and try everything for myself, fail a bunch of times, and hopefully in the end figure out what works. Tonight I want to share 5 things specific to stock market investing that I learned the hard way. And I've spent a lot of money and a lot of time learning these lessons that I hope you won't have to repeat. The first thing is to make sure that you research the companies that you intend to buy stock in. Stock is simply a piece of ownership of that company. So if a company issues 1 million shares and you buy one of those, you own 1/1,000,000th of that company. Now it doesn't matter if it's 1/1,000,000th or 1/5 or the whole company that you're looking at. It's important that you do research, you do your due diligence, find out how much money the company is making, what the company actually does. It may not even be something that you support, and what the value of that company would be. I once built a portfolio almost entirely around stocks that were recommended in an online forum that I participated in. They were mostly technology companies, which was great in the 1990s. They went up and up and up, pretty much regardless of whether the company made money or not. Unfortunately, I didn't do much research into those companies, and when that bubble burst in 2000, the values of my companies went way down. And valuable lesson learned. One of the qualifications that I learned in researching companies is to buy quality stocks. It's easy to get sucked into the penny stock trap. A penny stock is a stock that trades for under $5 a share. And it's easy to think, well, it's only $2. If I buy 100 shares, I only have to pay $200. And in terms of dollar amounts, if it goes up 50 cents, or if it goes up to $3, I make 50%. So it sounds pretty easy. What I found is that it's just as easy for that $2 stock to go to $0 as it is for that $2 stock to go to $3. And I learned that the hard way. That leads into lesson 3, that the value of the company is important, not so much the stock price of that individual share. IBM right now may be underpriced at $120 a share, while Ford might be overpriced at $7 a share, just because of the direction of the companies, the things they're doing, the way they're making money or not making money. I once bought a company called Cisco Systems, and the primary reason I bought it was that it was on sale. It had been $80, and now it was only $20. The problem was, it wasn't even worth $20. It went down further, and 9 years later, it's only trading just above $20 today. It's like 22 or something. So it's value, not price, that's important when you're looking at an amount to pay for a stock. No matter how much research you do, no matter how much you qualify and make sure it's a solid company, and how perfectly you peg the value of that company, you can't know everything. I think we've seen a lot of companies in the past year, and certainly when Enron crashed a couple of years ago, we saw the greed and the deception, the fraud that went on behind the scenes that no investor could know about unless they were involved in it. It's pretty easy to pad the books to make a company look a lot more profitable than it is. So number 4, diversify. When I left my previous employer, Valley Quarries, I rolled my 401k into an IRA so that I didn't have a lot of money at that time, so I picked two companies that I liked. They were young, growing companies. Unfortunately, at different times over the years, they both fell upon hard times and the price fell. I wasn't properly diversified, and I lost most of the value of that portfolio. So I've learned to diversify as well. Anniversary. This spring will be 10 years anniversary since that bubble burst when the tech stocks crashed and a lot of the market with them. My final lesson is margin. I learned a valuable lesson in margin during that spring of 2000. What margin is, basically, the brokerage allows you to trade as a loan. They loan you the money. If you have $1,000 in stocks, they'll let you buy another $500 worth of stocks using that $1,000 stocks as collateral. Unfortunately, when the bubble burst, that $1,000 was only worth $500 now, so I didn't have enough to back up my the other $500 out. What they do then is give you a margin call. Unfortunately, I was in Florida at my grandparents that week, and I didn't receive the call. So the market crashes. They call, say, hey, you need to put more money in your account. I'm not there to take the call, and they sell out. So all of my stocks got sold out at that low point. I get home, market's back up a little bit. It's too late. I'm already sold out of this. Valuable lesson, and very expensive lesson in margin. Warren Buffett is one of the richest people in the world. He made his money in investing, and he has a couple rules about investing. Rule number 1 is don't lose money. And rule number 2 is see number 1. I hope these illustrations of my shortcomings will help each of you follow rule number 1 a bit better than I